Hey everyone, welcome to another video in this restaurant industry mini-series. I began by looking into Starbucks, and today I want to do the same thing with Domino's. In this video, I'll go through Domino's annual report so we can understand the business, then I'll go over the business strengths, the risks associated with this company, and finally I'll finish off with a valuation of the business. Hit the like button to support the channel and subscribe if you enjoy this type of research content. Let's dive right into it. Domino's is the largest pizza chain in the world with nearly 20,000 restaurants in more than 90 countries. They focus on delivery and carry-out, so no dining in at all, and unlike Starbucks, Domino's runs mostly as a franchise. 98% of all their locations are owned by franchisees. They make money mostly by selling food and equipment to their franchisees and also by collecting a royalty fee. Internationally, they grant geographical rights to master franchisees, and we'll go over these in a bit more detail in a second. But what's important is that every stakeholder in the system benefits, and at the bottom here we see that Domino's really focuses on being a convenient and economical choice for consumers. Domino's reports three main business segments: the US, international, and supply chain. US stores account for 34% of total revenues, and of that, 94% of stores are operated by franchisees, and the other 6% are company-owned stores. Domino's uses these stores as testing sites for innovation or to train new franchisees and staff. For the stores that are franchised, Domino's charges a royalty fee equivalent to 5.5% of sales, and of all these fees that Domino's collects, 6% goes to the Domino's National Advertising Fund, which focuses on advertising and other activities that promote the brand. 7% of Domino's revenues come from their international franchises. The vast majority of international stores operate under a master franchise agreement. Basically, the master franchise is one entity, like a mini company that gets exclusive rights to an entire region. As you can see here, these mini companies are often traded in foreign stock exchanges. For example, you've got Jubilant Foodworks, which gets exclusive rights to use the Domino's brand in India, Nepal, Sri Lanka, and Bangladesh. These master franchisees pay a one-time fee to Domino's whenever they open a new store, and then a 3% royalty fee on all sales. And finally, the last 59% of revenues at Domino's comes from their supply chain. They own a bunch of supply chain centers, tractors, thin crust and vegetable processing facilities, etc. These centers produce ingredients needed to make pizza, and Domino's sells the products to their franchisees all over the world, but mostly in the US and Canada. And Domino's shares 50% of all the profits from these operations with participating franchisees, so really it's a win-win for everyone. So that's it. That's the basis of Domino's business model. If you're still with me after that, props to you, my G. Now let's get to the interesting stuff. Why is Domino's such a strong business? Do they have a competitive advantage? And if so, where does it come from? The restaurant industry is known for the notorious intensity of competition and the very low switching costs for consumers. We can simply decide to dine in one place rather than another. And as such, very few companies in this field can realistically be said to have a moat. Having said that, I think Domino's is one of these few companies for four main reasons, which are all somewhat connected to each other. The first aspect of Domino's moat comes from the brand. And this is a weird one, because usually I only consider brands as a moat when they allow a business to charge a higher price than competitors for the same product. But in the case of Domino's, the brand is not about the product itself, but about the message it conveys. When people think of Domino's, you have a very specific image in mind: cheap, convenient, and consistent pizza that never fails to satisfy a craving. This is the Domino's brand. Anyone can make a pizza, but who else has a Domino's type of service? Add to that the fact that bread and cheese is a combination that is palatable in most cultures, and you get a concept that is easy replicable internationally. Domino's same-store sales growth has averaged 4% in the US and 5.4% internationally since the year 2000. That outperforms competitors like Papa John's and Pizza Hut, and it also outpaces inflation in the food away from home category, which has averaged 2.7% between 2016 and 2020. This right here is evidence of a competitive advantage. Being able to keep growing despite heavy competition from other fast food restaurants and independent pizza restaurants for so many years. And the quality of Domino's growth is also important to highlight. This is a company that grows its sales by increasing volume of units sold rather than by increasing the price of units sold. This focus on sales volume rather than profit margins allows Domino's to maintain low prices, which is obviously an advantage if you want to keep customers coming back and compete effectively with other pizza franchises. This is quite similar to the way Amazon or Costco operate, throwing margins out of the door today in order to prioritize future earnings potential. The second aspect of Domino's moat comes from the franchisees themselves. Let me explain. According to Morningstar, cash-on-cash returns for Domino's stores hover around 50%, meaning that franchisees who decide to open a store can get all of their investment paid back within 2 years. This is better than most competitors, which explains why Domino's is one of the best concepts to franchise for new operators. And if you add to that the fact that Domino's aligns its interests well with franchisees by sharing 50% of profits from the supply chain with them, you get a very attractive investment for franchisees. So clearly, the demand for new Domino's stores is there. Let me repeat that. The demand for new stores is there. But Domino's is quite picky with who they sell their brand to. For example, in their 10K, they say, "We apply rigorous standards to prospective US franchisees. We generally require them to manage a store for at least 1 year and graduate from our franchise management school program before being granted the rights to franchise." Substantially, all of our independent US franchise owners started their careers with us as delivery drivers or in other in-store positions, which we believe offers advantages in terms of familiarity with our business and store operations. We generally restrict the ability of US franchisees to be involved in other businesses, which we believe helps focus our franchisees' attention on operating their stores. So franchisee contracts are for 10 years, during which the franchisee needs to stay loyal to Domino's. They can't open another store with another concept like McDonald's or Starbucks, for example. Keep in mind that usually franchisees own on average 8 Domino's stores, all of them having different end dates to their contracts as they are probably not inaugurated all at once. This results in a 99% renewal rate of franchise agreements and a very sticky franchisee base. I believe that this unique relationship with franchisees gives Domino's a moat in the form of switching costs from a franchisee perspective, as opposed to from a customer perspective. Yes, as a diner, it's easy for you or me to choose to order Pizza Hut instead of Domino's tonight. But once you become a franchisee of Domino's, you will most likely remain a franchisee for a very long time. For example, in 2021, Domino's opened 214 stores in the US but closed only 9. Part 3 of Domino's moat comes from their extensive cost advantages related to the scale of the business. This is one of the biggest restaurant chains in the world, and having such a large size allows Domino's to command better prices for the procurement of food and supplies, but it also allows the company to spread the costs of advertising and technology improvements on a larger base of stores. On that end, very few companies can match Domino's. But the strategy I want to emphasize in this segment that really differentiates Domino's from the rest of the pack is a concept that the company refers to as fortressing. This is basically a strategy where Domino's increases the concentration of stores in one area. And what this does is it improves the route density for drivers when they deliver pizzas, which leads to better delivery times and decreases costs per delivery. Because each time a new store pops up in an area that already has a number of stores, a group of customers will get physically closer to the new location and start ordering from there instead. Now, drivers leaving from that location to deliver pizzas have a shorter route, meaning less cost for gasoline, less wages to pay, more drops per route, and more tip income for the drivers. And if all of this makes you think, wait, if you increase the concentration of stores in one area, won't the new stores sort of steal customers from other stores that were around before, but a little bit further? If that was your thought process, congratulations, you've got a sharp mind. You would expect that to happen, wouldn't you? Well, according to management, 90 to 100% of sales at the new stores come from new customers or at the expense of competitors, despite the smaller territories covered by each store. Not only does fortressing allow new stores to be built, but the vast majority of sales happening at these new stores are incremental. So Domino's isn't cannibalizing royalty fees from one store in order to get them from another. And just as a quick side note, Domino's also makes sure that when new stores open in an area, they are operated by existing franchisees that already operate stores in the same area. That way, relationships remain strong. And this feeds right back into the second point I made about franchisee switching costs, doesn't it? The last thing that's worth mentioning about fortressing is that it improves the ratio of orders that are made via carryout versus by delivery. Since adding new stores within an area effectively shrinks the service radius for each store, customers often get physically closer to their respective stores and choose to carry out their pizzas more often than using delivery. This is a good thing for franchisees because carryout has higher margins than delivery. There is no driver to pay, no fuel cost, etc. The last part to Domino's moat, I believe, comes from their superior technology and database. Domino's is as close as you can get to a tech company in the food industry. They are consistently innovating, for example, by using data to drive decisions around marketing, regional pricing, or driver tracking, which improves the customer experience. In addition, their Pulse POS system featuring 20 years of customer data such as order histories, payment info, popular item pairings, and promotional sensitivity of individual customers offers Domino's a more complete view of their customer base than any other competitor in the space. And the way the company uses this data is also very important. How to price new items, which locations to add stores for fortressing, how to innovate their menu. These are all high-level decisions where Domino's can turn to their data for answers. At the end of the day, this is a super asset-light company that spends most of the capital that it earns from royalty fees on reinvestments into advertising, technology, and shareholder returns. When we look at financials in a second, you'll see just how consistently they buy back shares, and they also raise their dividend every year like clockwork. This chart shows the annual dividends paid out by Domino's from 2013 to 2021. During these years, the dividend went from 80 cents to $3.76. This is a company that has an average return on invested capital of 35% with a cost of capital averaging 6%. When you get such a combination, you get a chart that looks like this. In less than 20 years, the stock has given back 3,000% if you include dividends. So, does Domino's have a superior business model? I believe so. Moving on to the financials, we can see that this is a company that grows revenues quite nicely year over year. And if you were to calculate the compound annual growth rate of the revenues from 2014 to 2021, you'd get approximately 10%. Net income and free cash flow are quite similar year after year, which is something I like to see. And the margins for both of these have been quite consistent over the years. If we look at shares outstanding, this is what I was talking about with the share buybacks. You can see that every single year the share count goes down. And again, if you were to calculate the compound annual rate of share buybacks, you would see that it's about 5%. Super high return on invested capital. I love that. Dividends paid in 2021 were 139 million. This is really well covered by the free cash flow. You can see that in 2021 this was 560. So their payout ratio is about 20%. This is very safe. One thing I do have to mention with Domino's is they have a lot of net debt. This is a highly leveraged company, and it's not getting better over time. It seems that every couple of years, they just increase the amount of debt on the balance sheet. This is just how the business has been operated since 1998. It's definitely a source of risk. There's always the chance of a blow up when a company is full of debt. But in the case of Domino's, this is a company that is still rated BBB+ by S&P Global, the credit rating agency. I think this comes from the fact that at the end of the day, Domino's is a very safe, predictable, non-capital intensive business. And that allows them to take on more debt than a business that would be less predictable. But what we all want to know on this channel is how much to pay for such a good business. Because no matter how good the business is, if you overpay, the returns will just be mediocre over time. So for that, we try to extrapolate until 2030 and make calculations from there. In my model, I've used a revenue CAGR of 10%, which is consistent with the historical compound annual growth rate. I've used a free cash flow margin of 10%, which is also consistent with the history of this company, and also the share buybacks at 5% per year, which is also consistent. Using these numbers, you come up with a revenue of 9.4 billion by 2030 and a free cash flow associated with that of 945 million. I used a terminal free cash flow multiple of 20 for a very high quality business that has a moat, high returns on invested capital, and that is as profitable as Domino's. I think 20 is acceptable. So if we use a multiple of 20, that means we need to multiply 20 times the free cash flow of 2030. And if you do that, you come up with a market cap of 18.9 billion by 2030. If we take today's number of shares outstanding and decrease that by 5% per year until 2030, we get 24.1 million shares outstanding in 2030. And if you divide the market cap by the total amount of shares outstanding in 2030, you get a price target of $784 per share for Domino's in 2030. Based on that price target, and if you include dividends, in the last two rows at the bottom, you can see what your expected return would be depending on what you pay for today. Remember, you also want to give yourself some margin of safety. For myself, I've invested a small amount at around $385 per share, which based on this model will return a bit over 10% per year until 2030. If this was a less established, riskier company, I would probably have waited for a price that would give me 12 to 15% returns as an even greater margin of safety. But I plan on holding these shares for a very long time, so 10% doesn't seem like a bad deal to me. Don't blindly follow me though. Make sure you do your own due diligence before making any investments. That's the end of this video, my friends. I hope you learned something about Domino's business. I think this is definitely one to add to your watch list. Peace!